Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Well, what do we got going on in the markets today? We're getting some volatility, a big down day, right? Big gap down. And then went right back up trying to fill the gap. This is kind of a topping process as I see it. Eventually, we're going to have to break down below the 10-day moving average and then below the 20-day moving average. But right now, we're having a little volatility, getting a little shaky. I think the market's starting to break down. But right now, it looks like we still might fill that gap. Now, a lot of people are talking 5,000 on the S&P. I don't think it's going to get that high, but it's possible. I'm not ruling it out, but I do think we're getting ready to come in. Now, you see the Fed, they came out when they said no rate drop, right? They kept the rates the same. And they also took March rate drop off the table. But yet the market was expecting as many 6 or 7 rate cuts. And they're not going to get it. So that market's going to start to realize that, it might start coming down. Once again, just my take. We're in the topping process. We're taking rate cuts off the table. We're staying higher for longer. And the market's not going to like that, especially if they don't get any rate cuts. That'd be wild. The market would come crumbling down then. But so my take is a little topping process, but we're going to start coming down. All right, let's get over to, let's start out with the banks. Let's start with the banks. Okay, we got another one that's in trouble now. Okay, the New York Community Bank, right? New York Community Bank Corp. Their stock was trading a couple days ago at $10 and change. Now it's trading at $5 and change, roughly 50% off. Now what happened? What happened? You see, now New York Community Bank Corp, what'd they do? Well, they bought some of the assets from Signature Bank. Now, Signature Bank was the one that failed. And when they fail, the FDIC comes in, bails everybody out, and then they sell off the remaining assets. So they sold off some of these remaining assets to New York Community Bank Corp. And now nobody wants to do business with the New York Community Bank Corp because they think they're going under. So they're having a problem right now. They're having a problem now. We know that the Fed, they're going to cancel that bank term funding program. They say they're going to cancel. It's not March yet. March 11th, they're supposed to cancel that. No longer can you borrow your money there. You're going to have to go to the discount window. And when you go to the discount window, it's kind of like it's a stigma on the bank, right? It means that the bank's in trouble, so no one wants to go borrow at the discount window. So it's going to be real interesting when we start seeing the dominoes. But the first one in the United States that's going to be falling this year looks like New York Community Bank Corp. Hopefully you don't have any money in there. A lot of the banks aren't safe right now. The reason being is the bond market. The bond market's getting ready to be choked out like big time wrestling. It's got it in a chokehold. The bond market is not going to be doing well. Look, it's having a little rally here, but I think you're going to see new lows on that bond market pretty soon because the auctions, they're just not going as smoothly as they should be. I think the bond market's going to get choked out later this year. We'll see how that plays out, but that's just my take. The regional banks, they're all in trouble from the bonds, from the commercial real estate. Regional banks took a hit. They've come down in their valuations. Well, their stocks have, dropped about 6%. All right. Well, okay, so this is just what's going on with the banks. Now, the banks, they're in trouble, but you see, the real trouble is still, it's in the stock market, it's in the real estate market. Both of these are in a bubble, right? They're in a gigantic bubble. Now, real estate, we had the big bubble going into 2007, 2008, and the bubble popped a little bit. All right, so it popped, but what happened? They didn't let the bubble deflate, did they? No. They got out the pump and they started pumping, trillions of dollars into it, right? Trillions of dollars to make the bubble grow even bigger. Now, I get it. The real estate market in many areas is still moving along, still at record high prices, almost as high as where Billy Bob got out at, still up there, still in some areas going up where the Moon Boys live. It continues to go up. But you see what's happened is they had the first bubble, it popped and the air came out, pumped in the trillions of dollars, made the bubble bigger, right? Now, every bubble fails. Every bubble pops. There's never been a bubble in the history of the world that hasn't popped. But people will tell me, but Mike, it It's different this time. We can blow these bubbles as big as we want. We got the printing press. We can keep printing the money. We got this modern monetary theory where it doesn't do any harm to print the money, so we keep printing the money. But you see what happens at the end of the bubble? They want to draw everybody in, and they're doing that in the stock market. Stock market hit that record high, draw everybody in. That's why I think we're going to start coming down in the stock market. We'll see. But the real estate bubble, same way. Same way. They got all these articles coming out of how you better hurry up and get in, why interest rates are low. They're not that low. They're about, 7%? Yeah, they were 8%, came down to 7%. I don't think that's that low. It's not that high either. But the prices are incredibly high. Incredibly high. Why? Because they inflated that bubble so big. That bubble is at a record high, right? And I mean, we've had this, let's call it an economic surge. It's not really an economic surge. It's a surge in the stock market, a surge in the real estate market. And this has been going on, roughly what was it? 2008 was the financial crisis, right? So we've had a 15-year bull market, a 15-year surge, right? Where we push these assets up higher. Now, do you realize that is 50% longer than the longest surge in the history of the United States? So 15 years is an incredible long time to go without the recessions, without the depressions, without the bear markets. It's just been going up. And a lot of the moon boys will tell you it's going to keep on going, keep on rolling higher, and maybe it will. That's not my take. At some point this breaks. Do we have another year? Election year, right? They want to prop it up. They want to get their man to stay in there, right? And the only way they can do that is if the economy's good. If the stock market looks good, the economy's circling the drain. But if they can push the stock market higher, push the real estate bubble higher, maybe they can buy some votes that way. But this bubble is getting ready to burst. It's just getting ready. And once they start to burst, they really pick up momentum fast. Okay, all right, so in 2008, where the real estate bubble popped, okay, so it was coming down really fast, 34%. Now it would have came down over 50%, but they started pumping trillions of dollars in. So we're kind of still in the same bubble. We never let it play out. You see, what people don't understand is a recession's actually a good thing. Gets rid of the bad investment, clears out the financial system, and then you start to rebuild and get things going again. If you don't let the recessions happen, you're going to fall straight into a Great Depression, and people are not going to be very happy when that happens. And it's going to happen, maybe we got another year. I don't know, maybe 2 years. 3 years, that'd be really pushing it. I'd be impressed. Be an 18-year run straight up? I don't think so. I think things are starting to turn. Now, why do I think things are starting to turn? Let's talk about this. All right, there's a retirement crisis. People my age, people in the age bracket of 55 to 66 years old, right? Okay, over half the people in that 10-year span, they have zero savings for retirement. Zero savings. They're going to depend on Social Security. Now, granted, Social Security is already broke, already bankrupt, already insolvent. That's part of the $100 trillion in unfunded liabilities. Yes, we're going to print the money, and yes, you're going to get your Social Security check, but it's not going to be worth anything. I'm telling you, the purchasing power of the dollar is going away, and eventually it's going to go to zero. Now, other countries are not having this problem. You see, we got 50% of people getting ready to retire, zero money saved, and they're going to be living out their retirement years in basic poverty, trying to survive on a Social Security check. And a lot of people are already doing that. Now, in other countries, they work 25, maybe 30 years, but they retire with dignity. In the United States, not so much. The reason being people live longer, right? Now, when Social Security, when it first started out, it was back in 1935, right? Long before even I was born. Okay, but anyway, started back then, right? So they started it that you could take Social Security at what? 65. How long did people live? They lived to be 62. So let me think about that. Live to be 62, they could take it. If they made it to 65, then they could get it, right? So what about today? Well, you can now take it at 62. Not your full one, though. The full one, you got to wait till 66. But you can actually start taking Social Security at 62. But how long are people living? almost 80 years old. 79 is, I guess, the age where average age people go, but 79 years of age. Some people make it to 100. You start taking at 62, you got 40 years of collecting money, collecting the government money, right? So when they started this Social Security program, I don't have the exact figure, but something like 18 people were working for every one that took Social Security. Okay, what is it now? 3 people working for every one that gets paid Social Security. And it's soon going to be down to a 2-to-1 ratio. Now look I'm a baby boomer. I want my Social Security. So you millennials, you guys don't mind being taxed a little bit more so that I can get my Social Security, do you? I mean, that'd be great, right? If you could just work a little longer, a little harder, a little overtime, maybe. We got to get that money into the Social Security so they can pay the old people like me. But there's a retirement crisis going on. It's a retirement crisis. Now, where's the real crisis? It's in the pension funds. See, the pension funds, they're trying to catch up. They've invested your money in the bonds. They've invested your money in the commercial real estate. You know what? They're starting to invest your money in cryptos. Well, they now have ETFs on cryptos. So let's hope they go to the moon, because these Social Security and this pension fund, they need more money to come in. And they don't know where to get it. So they're starting to take leverage. They're starting to take risk, right? So this is just not going to play out well. But the crisis is in the baby boomers. And us baby boomers, what are we going to do? Well, some of us baby boomers own a house. We don't have any money. We're house poor, really. We got all our money in the house, so we have no money to retire on. Well, what are we going to do? We're going to sell that house to get the retirement money. Now, where are we going to live? I don't know. Maybe everybody moves to Nebraska. That's what my mom did, right? Okay, so Nebraska's really cheap. You can still get a house there for under $50,000. And it's not that bad. So it snows in the winter. So it's 120 in the summer. It's really not that bad. Well, that's where a lot of people might be living. Some people are going to leave the country, Costa Rica, Colombia, other countries, because they can take their Social Security check, and it buys more there because the Social Security check is not going to buy anything in the U.S. So a lot of people are in retirement, coming into retirement age, have zero savings. The one that do have money, well, they got a house, and they're going to run out of money because things are getting more expensive. They're going to be dumping the house. Hopefully your millennials will buy that, because you're going to be working longer, working harder, paying higher taxes, so us boomers can go out in style, right? We want to go out in style and at your expense. Isn't that great? Oh, yeah. Well, anyways, I got carried away there. Sometimes I do that, but I think this is going to bring the housing market down a little bit. I think the boomers are going to be dumping their properties. I got one for sale coming up this weekend. Got the open houses. It's going to fly off the charts because there's demand still. Demand is still there, right? It's still out there. Someone's going to buy it. I don't know who, but I'm expecting it to sell. I expect it to sell over the weekend. I'm hopeful. But I mean, but it's ridiculously priced. I mean, there's people out there. And here's the thing. I live in a wealthy area. I live next to Apple Computer, right? Apple Computer. People go in there and they make $400,000 or $500,000 a year as a software engineer or something. They have money to go buy these houses. You see, the top 1%, even the top 10%, they have so much money they don't know what to do with it yet. So they can still go buy houses, $2, $3, $4 million houses. I mean, that's just because there's 2 of them working at Apple. Let's say they each make $400,000 to $500,000. So they're making, as a couple, they're making $800,000 to $1 million. And yes, they can go and afford to buy this $3 million house that I'm going to be selling. And that's great, because I could really use the commission. Anyways, I'm Tall Mike. I got a little carried away here. It's a Friday. Get out there, everybody. Have a great weekend, but give me the thumbs up first. Why not? Bye-bye now.